Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to this exploration of privacy coin investing with our guest, Jordan Clifford, co-founder and managing director at Scalar Capital. Before Scalar, Jordan was a lead growth engineer at Coinbase and a business analyst at Capital One. This episode is broken into 8 chapters. In chapter 1, we explore Jordan's background as well as Scalar Capital's origin story. In chapter 2, we talk about Scalar's thesis and approach to deploying capital. In chapter 3, we consider the privacy coin landscape. In chapter 4, we deep dive into Jordan's favorite privacy projects and why they matter. In chapter 5, we briefly discuss decentralized exchanges and their role in privacy. In chapter 6, we discuss the state of institutional involvement in crypto asset investing. And in chapter 7, we talk about Jordan's favorite crypto resources and events worth attending. Finally, in chapter 8, we play a lightning round of overrated, underrated. We'll get to the episode in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by the privacy coin Veil, which funded this episode and made education about privacy coins and privacy coin investing possible. Veil defines itself as privacy without compromise, providing anonymity through a combination of technologies like ZeroCoin and Ring CT. Having launched this year with over $1 million in seed funding, Veil boasts an experienced team, including members working on Ravencoin, PivX, and more. Before its launch, the Veil team released the X16RT mining algorithm, which has been adopted by projects seeking resistance to ASICs and FPGAs. Veil's hybrid proof of work and proof of stake consensus lets users mine the coin, stake with ZeroCoin, or both. Veil states that staking with ZeroCoin allows Veil users to earn rewards anonymously by holding coins in their wallets. Find Veil on leading data feeds like Nomics, CoinMarketCap, Blockfolio, and CoinGecko. To learn more about Veil, check out their website at veil-project.com. Join their Discord and Telegram chats, or follow them on social media at Project Veil, spelled VEIL. Thanks again to Veil for making this episode possible. And again, to learn more about them, you can go to veil-project.com. This episode is also brought to you by the Nomics API. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, then consider trying out the Nomics API. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developer have to spend too much time cleaning up and maintaining data sets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomicsapi.com. Okay, back to our regularly scheduled program. Here's my conversation with Jordan Clifford from Scalar Capital. Enjoy. Let's start with chapter 1, which is an exploration of the origin story around your involvement with crypto assets, as well as the origin story of Scalar Capital.
As a kid, I was really fascinated with technology. That led me to study computer science at Carnegie Mellon. And at Carnegie Mellon, I added a second major in economics because I found that really interesting as well. So I've always really liked having a foot in both the finance and economics world, as well as the technology and computer science world. I've worked as a business analyst as well as a software engineer. So it really kind of caught my interest when I first heard about Bitcoin in 2011. Initially, I was rather skeptical. I actually was looking for ways to short Bitcoin. Luckily, I never found any ways to short it at that time because it would have been a painful road for me. I followed it for a couple of years, 2011, 2012, just on the sidelines, reading whatever occasional article popped up in mainstream media like Wired. I think I originally found it on Slashdot. But then in 2013, I saw the Cyprus incident happening in Europe, where the Cyprus government thought it was a good idea to seize their citizens' bank account balances. And this sent Bitcoin from $30 to $260. And at that point, I really couldn't ignore it anymore. I thought that was a rather amazing summit. So I read the white paper, I bought some Bitcoin, and I've been super fascinated by this technology ever since.
Yeah, that's really interesting what was happening kind of at a macroeconomic scale during the Cyprus crash. I heard a lot of people, refer to that as, being their entry point into the space. They started realizing the utility value, along with events in Argentina, Venezuela, Zimbabwe, et cetera. I think it's really hard to get exposed to the most critical use cases for Bitcoin when you live here in the United States.
Yeah, I think that's right. I think that a lot of these technologies, the very first adopters are needs-driven adopters. It's not going to be the person in New York City or San Francisco that is the first adopter of cryptocurrencies. They just don't have any need to. The payment systems work pretty well here, and the banking systems work pretty well here. But over in South America and Africa, Southeast Asia, a lot of these places, there just are no other options for getting access to the financial system. And I think that those are going to be some of the places where you see real user adoption pick up, probably in the coming years.
Heard a little bit about your personal history with the space as an investor. What has been your relationship to the space as a software developer or as a computer engineer?
I worked at Coinbase for a year and a half. I did a lot of internal systems at Coinbase. I was a back-end engineer. I did a lot of refactoring and adding features to the compliance systems. So every action that a user takes on Coinbase, it actually goes through a deep set of systems that verify that action is allowed by law and is compliant. And there's a number of indicators that have to be looked at and a number of systems that all those things go through. So that's where I met my co-founder for Scalar Capital, Linda. She was a product manager at Coinbase, and we worked together to really make sure that the company's operations were running really smooth.
Very cool. And what was Linda's role there?
So Linda joined Coinbase as a compliance investigator and later got promoted through the ranks and ended up being product manager for all the internal tools. So basically every back-end system that employees would interface with. So all the fraud detection systems, the legal systems, the compliance systems. She was the one writing out tickets and creating specs for how we should upgrade those.
I want to transition in just a bit to Scalar Capital and your story. But first, I want to ask something that just came to mind when you were talking about compliance and compliance systems, which you both were involved in. And that is, did Coinbase's audits of the history of crypto assets and, I don't know if policing is the right word, but the checks and balances they put on tokens before they come into the Coinbase ecosystem, did that have any bearing on your proclivity or interest in privacy coins and privacy in general?
I would say yes. I don't think it was the genesis of my interest in privacy. I've been really inspired by kind of the origin story of Bitcoin and the Cypherpunk kind of culture. The Cypherpunk Manifesto is one of my favorite short essays. I would recommend everybody read that essay. It's not long, and it definitely fires you up in terms of making systems and building software that actually protects the individual liberties. So that's really rooted in Bitcoin, and the fact that Bitcoin really doesn't encourage address reuse. It encourages new addresses every time. So Bitcoin on its own has already kind of had that privacy culture, but by working at Coinbase and seeing all the compliance systems and seeing all the all the blockchain analytics that were going on and all the tracing and all the subpoenas and law enforcement, it definitely reminds you that, this is not private by default. This is actually quite public, all of your dealings on the blockchain. And maybe that's not the best answer for most people for the long term. I'm sure we'll get into privacy a bit later, but privacy is really not just about big bad government spying on you. It's also about your neighbor. It's about your friend. It's about Russian hackers. You really don't want to be revealing all kinds of personal sensitive financial information when you use a transactional network.
As a Coinbase user, I recall one incident where I tried to transfer tokens to what Coinbase deemed a questionable address. got my account flagged and shut down for a couple of days until support reopened things for me. I've also had friends who tried to import tokens from, I guess, that Coinbase deemed to not have a great history. Can you share what you're able to about the checks and balances on coins flowing in and out of Coinbase and similar systems?
Well, I can't get into too many specifics, but Coinbase works with a number of vendors that are really solely focused on blockchain analytics. So they do a lot of wallet analysis. One of the ones out there is Elliptical, and then there's Chainalysis. And I think we've worked with both of those in the past. They are actually out there just profiling the entire history of the transactions on the blockchain. And they are able to, figure out, is this a gambling website? Is this a darknet market? Is this, something even worse? And they'll actually, work with Coinbase to find whether users are interfacing with things they shouldn't be. Yeah, that's about as much as I can say.
What are your personal views about the fungibility implications to that kind of work?
Well, personally, it's very concerning. I mean, you don't always know who's taking these actions, and you don't want innocent people getting caught in the middle. If I'm getting money back from my friend Bob, and Bob happened to sell some marijuana for that money, and then he sends it to me, I don't want to be cast suspicion upon when I go and spend that money. We don't trace $100 bills and really, if that $100 bill has been used for cocaine trafficking, look funny at the person, because we just don't know. A $100 bill is fungible. I'd like cryptocurrencies to be that same way. I think that it really is a chilling effect if you can trace the history of a money and see that it's been used in some illicit act in the past, and then hold that against the current bearer of that money. I think that's a really negative thing for the whole system, and it makes people a lot more cautious about accepting money and about freely transacting in the way they may want to.
I think this is probably one of the major areas where the analogy to digital gold breaks down. Like there's no history attached to that gold that might have been involved in terrible things, but the current holder of that gold shouldn't be held responsible for the past actions of the holder of that gold. Let's transition a little bit to Scalar Capital. So you and Linda are working at Coinbase, and what are the roots of Scalar Capital? What kind of conversations did you start to have that led to the formation of Scalar?
Yeah, so Linda and I were both drawn to Coinbase through our passion for cryptocurrencies. And at Coinbase, we both were really active in terms of helping the company and helping our fellow colleagues understand crypto better. So I would run crypto office hours every 2 weeks, where I would just answer people's questions about, from basic to advanced, how does the blockchain work? What is SegWit? What is the Lightning Network? Like, why does all this matter? I would help my colleagues understand that. I ran Coinbase onboarding, so crypto onboarding. Whenever new hires would come in every Monday, I would give them a short 30-minute spiel about why crypto matters and what's exciting about this space. We both brought in a number of external speakers. So Linda brought in Vitalik. She brought in Fluffy Pony or Ricardo Spagni from Monero.
I saw that talk, Toxic Coinbase, right? It was a series on YouTube.
Yep. So a lot of these are on YouTube. I brought in Greg Maxwell. I brought in Peter Risen. We really like to engage with the community, the crypto community, and we really like to be on the front lines, learning as much as we can about the protocols, about the newest ways that our engineers are figuring out how we can get more bang for our buck in scaling, or expressivity in smart contracts. And we were finding that at Coinbase, we were less and less getting exposed to the cryptocurrencies themselves, the frontier of the cryptocurrency world. Coinbase started off as a Bitcoin company and has slowly expanded its offerings, but it's still a small sliver of the crypto assets out there. And Coinbase is not the place to get the latest and greatest crypto asset. It's not the place to get exposure to those. It's much more of a lowest common denominator mainstream. These coins are vetted. They've been poured over by compliance folks and made sure that state regulators are accepting them. So it moves a lot more slowly. And we were starting to feel like we wanted to be more on the front lines. So Linda suggested that we go off and set up an investment management company, and I was definitely on board with that. It sounded like a lot of fun. The idea of managing capital in this space is really alluring.
When you speak about the training that you did in the crypto office hours or lunch hours or brown bags or whatever, was that for internal training primarily?
Yeah, it was, I think, almost exclusively internal training. If there was any external people, it was probably someone's boyfriend or girlfriend they brought into the office that day. They just wanted to sit in.
I think there's all kinds of reasons that someone might join Coinbase, especially these days. A lot of people are just driven to the allure of stock options in a fast growing company. Other people really like DevOps challenges, right? Or there could be a whole bunch of, a whole host of reasons. Did you find that it was a challenge as Coinbase grew to kind of maintain that domain knowledge and kind of ear to the ground monitoring of what was happening in the crypto space? Was that a challenge as the company grew?
It definitely was. I mean, as the company grew, the industry grew even faster. And, the company had a lot of internal challenges that had nothing to do with the latest and greatest cryptocurrencies or the newest protocols. We felt like we were getting, again, pulled further and further away from the front lines. And we could have been working at a fintech company that didn't deal with cryptocurrencies. Our day-to-day jobs would have looked very similar had we worked at Venmo or PayPal. It was really the same kind of challenges. These are product challenges. These are payments challenges. These are compliance challenges. These are not really uniquely cryptocurrency challenges. And, I wasn't actually working on the cryptocurrency wallet integrations. There are some people at Coinbase that did do that, and they probably got a little bit more cryptocurrencies in their day-to-day work. But at the time I left, I was the lead growth engineer at Coinbase. So I was really focused on marketing metrics. I was doing things like Facebook campaigns and Google search engine optimization. And I was really trying to help craft the message for getting cryptocurrencies a little bit more accepted by the mainstream masses. So it really was, branding challenges and marketing challenges more than trying to figure out how Bitcoin is going to scale or what the Ethereum Casper protocol really looks like.
I think that's a really interesting point. I think the vast majority of jobs in this space are really, they're about UX, they're about biz dev, they're about partnerships, they're about regulatory compliance, they're about scaling pretty traditional databases, they're about copywriting and messaging and SEO. There's probably not a lot of jobs out there where you are just in the thick of the latest of what's happening in this space. And that's part of why I do this podcast. So I could see why, transitioning to investing in the front lines of this space, why that would be appealing. So what month and year did you guys quit and start raising?
August 2017 is when I departed, and then Linda left in September.
What is actually the latest instantiation of this template for a crypto hedge fund? I've heard it. It's an overseas entity with a Delaware LLC, or what's sort of the latest configuration that people are going with?
Well, I can't comment on everybody, but I know that what we have is a master feeder structure. So our actual investment vehicle is in the Cayman Islands, and that opens up a lot of doors. So we were able to get exchange relationships with pretty much everybody. We're able to get into pretty much any project. A lot of projects will exclude U.S. investors, but by having our investment entity, the investment vehicle itself in the Caymans, we're able to, avoid some of those exclusions. That's where the investment activity happens, and then there's feeder funds, both domestically and foreign, in the Caymans.
Are you guys denominated in USD?
Yep.
Let's move on to chapter 2, which is an exploration of your thesis and approach to deploying capital. What's your approach? And the reason why I ask this is because I've heard a lot of really compelling investment theses around crypto assets in general, versus traditional asset classes. I've heard fewer compelling differentiators among other crypto funds. And I think it's because a lot of people are providing basic exposure. Like that's the state of institutional investing, is like there's crypto assets and we want exposure. But I think the space is starting to mature a little bit. Someone who's investing in a few different crypto funds wants to, diversify their bets. How do you describe your thesis to that person?
We believe that crypto assets are going to uniquely enable all kinds of commerce that wants to happen today, but just can't because there's no way to make the transaction happen. All of the existing payment rails, all the existing banking systems are, either too slow or they're too cumbersome or too expensive to make some of these transactions happen. And these are things like micropayments. These are things like novel applications, new marketplaces, new prediction markets. It's really hard to pinpoint what exactly it's going to be. I think it's going to be a bit of all of these things. I just think we're really early and we're still at the infrastructure layer and protocol layer. And we still have probably 2 layers to go before we can actually interface with, Joe Schmo and have him be comfortable using these systems. The main thrust of why we're here is the uniquely enabled commerce. This is a way that any two peers, peer-to-peer transactions can happen. Anybody in the world can accept payments from day one. Anybody in the world can send money to anybody else. This is like akin to the internet, but what the internet did for information, these networks are going to do for value. And when you kind of interweave them together, you're going to see some magic happen. But it's still so early. Like, I can't stress that enough. Like, if you actually go and look at the developer tools that people are playing with, it's so easy to shoot yourself in the foot. It's really hard to get confidence in what you're building. It's really still a frontiersman's game. It's like the pioneers are the ones with the arrows in their backs. And like, that's kind of where we're at. I think we really need to, have a bit more settling down, a lot more maturity to the tools and the development ecosystem. We really believe these networks are going to just enable all kinds of commerce. And our focus is a bit on the privacy. So that's the main focus of our fund. We've talked about privacy a bit, but privacy, again, is the ability to conduct your transactions without needing to worry that somebody else is going to be able to profile you or learn information about you that you maybe would rather keep to yourself or keep between yourself and your auditor. There's no real reason to reveal everything about your finances to the public. And that's something that we think is really undervalued. And that's something where we look extra careful to find novel approaches to privacy and scalability. So those are the 2 main challenges we think that are out there is getting these networks to behave in a way that people can feel safe with their information, and also getting these networks to behave in a way that lots of people can use them without degradation of performance.
What would be like some of the macro trends that you're betting on? It sounds like one of them is potentially the increase in desire for privacy over time. Maybe, step 1 is adoption, and step 2 is, holy shit, the IRS and Chainalysis and Coinbase and everyone in the world can see what I'm doing. Let's protect against that. Is that one of the trends you're betting on?
Yeah, I think that, really these assets are powerful in that they empower the individual from censorship and asset seizure, and they empower the individual to custody their own assets. And that's, something we haven't really had, where you can actually have financial assets that you can custody yourself. Outside of bars of gold or cash in your own vault, but something that you can actually custody yourself that still can interface with the rest of the world and you can still transmit very easily. This is something that's rather new, the idea of being your own bank. And it's something that I think we're betting on will catch fire in places like Latin America, Southeast Asia, and Africa. So I think that's kind of a global macro trend, just banking the unbanked that we're fighting for. And then I think that a lot of these decentralized applications, and that's also a tailwind that it's going to take some time to really pick up, but we'll be quite strong once it gets here.
Let's transition to chapter 3, an overview of the privacy coin landscape. And when you think about the different categories of privacy or the different legs of the crypto privacy stool, the different kind of components that exist here, what does that landscape look like to you?
Any action that a user is taking on the network has side effects, and those side effects are observable to some set of people. When you think about privacy, there's the idea that I hold an asset and people shouldn't be able to tell that I'm holding it, and then I can spend it. People shouldn't be able to tell who I'm spending it to, when I'm spending it, how much I'm spending. So that's kind of, I guess, the storing of value and then the transmitting of value. You want to have there's different privacy problems with each of those situations. And then there's also smart contracts and keeping privacy there. So there's the data layer, there's the actual executional code, and the transactional graph of what's happening. And you want to be able to, in an ideal world, only be revealing enough information to the world that they can verify your transaction happened. And they shouldn't really be able to figure out why it happened, who it went to, when it happened, how much it was for. Privacy is a cat and mouse game about minimizing the metadata that you're leaking and minimizing who that metadata gets revealed to. And really, you want to only have that metadata be a proof that the transaction happened. So this is like a ring signature or a Zcash snark, where it's a proof that something happened, but you actually can't tell what happened. And this is kind of really the magic of cryptography, that it allows us to build out these tools where we can verify that things are happening and that the whole system is correct, but we don't actually need to see what's actually happening. And it is kind of a mind-bendy thing at first, but it's really rather exciting.
When we were talking earlier, you mentioned, privacy coins as a percentage of overall crypto market cap. And I think the implication there was that these tokens, by and large, are undervalued right now. Is that a correct assessment of your views?
Yes. We think that people are going to start to pay attention more and more to their own privacy. They already are a little bit with their data and some of the backlash we've seen. And as they get more involved with these networks, I think they're going to start to prefer networks where they feel safe knowing that when they transact, they're really not compromising their own information. What
is the percentage of total market cap that is captured by privacy coins right now?
Last I checked, it was around 3%. I know these markets are quite volatile. I haven't recalculated that in a few weeks, but it was around 3% when I last looked.
Here in Chapter 4, I'd like for you to break down some of your favorite privacy projects. What stands out to you right now in terms of innovators in the space and projects that you are particularly keen on?
Monero is by far my personal favorite privacy project. They have just an amazing track record of coming up with improvements and shipping the improvements and actually delivering those improvements to users. There's a lot of great ideas in this space, but there's less actual execution and timely execution. And Monero really stands out as a team that ships. So I've really been a big fan of them, and I really like a lot of their design decisions that they've made. So, for example, they really favor mandatory privacy. So mandatory privacy is the idea that if you're going to use the system, you're going to get privacy. And this protects the users of the system from themselves and also from each other. So if you offer optional privacy, that's problematic for a couple of reasons. One, that person isn't getting any privacy. But two, that person's also kind of casting a little bit of suspicion on people who are opting for privacy. Why are you using privacy if you don't need to? And it's, you're kind of casting suspicion on them when really that should be the default. Like, I shouldn't have to reveal everything about myself when I transact.
Hey, I wanted to pause for a second to let you know that this episode of the Flippening podcast is brought to you by the folks at Veil Project, who believe in sponsoring educational material about the privacy coin space. Veil defines itself as privacy without compromise, providing anonymity through a combination of technologies like Zero Coin and Ring CT. Having launched this year with over $1 million in seed funding, Veil boasts an experienced team, including members working on Ravencoin, PivX, and more. Before its launch, the Veil team released the X16RT mining algorithm, which has been adopted by projects seeking resistance to ASICs and FPGAs. Veil's hybrid proof of work and proof of stake consensus lets users mine the coin, stake with Zero Coin, or both. Veil states that staking with Zero Coin allows Veil users to earn rewards anonymously by holding coins in their wallets. Find Veil on leading data feeds like Nomics, CoinMarketCap, Blockfolio, and CoinGecko. To learn more about Veil, check out their website at veil-project.com. Join their Discord and Telegram chats, or follow them on social media at Project Veil. Thanks again to Veil for making this episode possible. And again, to learn more about them, you can go to veil-project.com. This episode is also brought to you by the Nomics API. The Nomics Market Data API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. If you're a professional investor or developer, you need accurate prices, and I can tell you that our competitors' prices are not accurate. We're actually going to come out with a report about this soon. I should also note that the Nomics API is used by many of the largest and most influential companies in the space, including top exchanges, $100 million AUM funds, and prop shops. Hit us up if you'd like more details, or go to nomicsapi.com. Okay, back to this conversation.
Monero does mandate privacy, and they consistently upgrade the level of privacy that they require. So the mixed-in size is, so this is, the mixed-ins are basically decoy inputs. So you could think of them as, when I'm spending my money, I'm going to also put in there some decoys that could be the ones that are being spent. And you're not going to be able to figure out which one it is through that ring signature. So the ring signature is going to be a combination of my actual inputs signature with a couple of others. So I'm going to take my public key, a couple of other public keys, and I'm going to smash them all together with a signature that looks like it could have come from any one of those inputs. And they've taken that mix-in level from, I think initially there was no required mix-ins, which is completely insecure. It's basically the equivalent of Bitcoin. To, they've upgraded it to 2, and I think it might be even 4 now. And they've also added Ring CT, which is a adaptation of the confidential transactions scheme that Greg Maxwell came up with for Bitcoin. And they've actually adapted that and deployed it on Monero. So now, not only do you have the transaction graph that's obfuscated, with Ring CT, you actually have encrypted amounts, and you can't actually see the amounts that are being transacted on Monero. And the way this works is through a homomorphic encryption. So that's a really fancy way of saying math over encrypted amounts. So if you homomorphic encryption basically encrypts amounts in a very special way such that the math still works. So you can actually verify addition, subtraction, equality. You can verify that the summation of the amounts is equivalent, even though you can't actually see what the amounts are. So this is a rather clever trick, and it's pretty amazing to see it working out in the wild. And then just one last thing about Monero. They've actually opted into a tail emission. So this is, there's a lot of game theoretic concerns that happen in sort of an end state when the mining rewards are out and the inflation schedule is depleted. And a tail emission is just the idea that, hey, we're always going to be providing our block producers, our miners, with a reward and keeping them incentivized. And this actually removes a whole class of theoretical problems from the network. So that's my favorite one. Zcash is also very, very exciting. They have a great team. They have brilliant cryptographers. The cryptography is very new. That's something that everybody should be paying attention to. This stuff does take time to mature. But Zcash has been very creative and innovative, and they've inspired a whole class of forks and knockoffs, which I don't think hold the same luster as the original, which is gaining much more of a network effect. They've been listed on Gemini. They've got a lot of exciting developments behind them. I think Barry Silbert's created a fund for it. They've got a lot of network effect as well, and we applaud and cheer on both Zcash and Monero.
It does seem like, perhaps it's because of the, required privacy with Monero that it has suffered a little bit, when it comes to network effects and adoption. It seems to be a little bit slower to be added to exchanges. Institutions haven't come out with, supporting it like they have with Zcash. Could you describe some of the challenges associated with, interacting with Monero?
Sure. So Monero, it has a property where you actually are never able to understand whether a transaction output is spent or not. So, in Bitcoin, it's very easy to see which transaction outputs are spent. It's all in the clear on the chain. And because of that, you can actually prune older data. You can run a light client that actually doesn't contain the entire history at all. It just contains the current set of transaction outputs. But with Monero, you have to keep the entire history, because you actually, the only way you're able to verify transactions is if you have the entire set of transaction outputs, and as well as the set of key images, which is another, it's a detail about the Monero protocol, but the key image is actually what protects you from double spends in Monero. The state of the ledger is there's a lot more data that you have to keep track of with Monero. So running a light client is actually very difficult, which makes it very hard to make a wallet for it on the phone, as well as on the hardware wallets as well. So there are some technical challenges with the approach that Monero has taken. I'm confident, and I believe that the benefits of this approach will win out in the longer term when, hardware is getting better and better, software is getting better and better. We're going to figure out ways to deal with the size of the Monero chain. It does follow that Monero is a bit more technically challenging to deal with. And we'll find out whether that added complexity is worth it, that added complexity and cost. And we believe that it is, but it's going to take some time to let the story unfold.
Zcash. I just am really into the purist approach that Monero has taken to privacy. That said, I've had challenges using the wallet on my desktop. It takes forever to download the damn blockchain. And every time I reload the wallet, I have to sync up, and that seems to take forever. I was encouraged to see, though, the other day, Trezor on Twitter posted a screen grab of the beta version of their Monero wallet. So Trezor is about to support it.
Yeah, absolutely. It's really exciting news. I haven't seen that, but Trezor is my hardware wallet of choice, and the fact that they're adding Monero is really exciting.
Thanks for explaining, ring signatures a little bit. We got into some of the technical details, but could you just sort of with a broad brush describe how ring signatures work? Is it essentially that with every block, there's a mixing event? Is that how it works? Or how would you describe it to the layperson?
So let's back up a bit. So a transaction in Bitcoin, in Ethereum, in any of these networks, a transaction is really two things. One is the state change. So we want to take the ledger from state A and move it to state B. And the difference is the state change, the transition of where the transaction is going to and from. So from address A to address B, that's the actual effect of the transaction. Okay, so that's the intended effect of the transaction. And then the other part of the transaction is the authorization. So how do I know that this transaction is valid and that moving from state A to state B is a valid thing? Like, does the holder of coins in state A really want them to go to B? That's the signature part. So that's the authentication. That says, yes, I am actually the valid owner of the coins in A. I want them to go to B. That's a true statement. And here's my cryptographic signature that shows I actually do in fact own those, and I do in fact authorize this change. In Monero, we actually don't specify who the coins are coming from explicitly. We make it a set of possibilities. So we say our coins is, maybe it's slot 1, or maybe we put it in slot 4. And then we also find some decoys. So these are people who have no idea this transaction is happening. They definitely aren't spending their money. They are out there on the chain, and we include them as possibilities for our transactions. So, we'll include our own input. We'll include 3 decoy inputs. And instead of authorizing my spending of my coins to be, I'm going to actually generate something a little bit different. And I'm going to generate a signature that authorizes one of these inputs going to be. And that one of these inputs means that my public key, as well as the public keys of the decoys, are all being included in the same exact manner. There's no special treatment for the real one. All the public keys are included, and then the signature is generated to include all those public keys, and the signature comes out and says, yes, in fact, one of these public keys authorized the movement of funds into this new address. And just so you can verify that this is unique, and I'm sorry I'm getting a bit in the weeds here, but just so you can verify that this is an actual unique thing and that I'm not spending the same coins more than once, here is a key image, which actually, you could think of it like a hash of the true input. The key image is emitted, and this key image set is what protects you against double spend. So when a new transaction comes out, you check the ring signature. Okay, I actually see that all these 4 public keys, the signature matches the 4 public keys, so I know one of these public keys actually signed it. One of the private keys corresponds to the public keys, actually signed it. And then here's a key image. Is this key image unique, and have I seen it before? If I've seen it before, that means somebody's trying to pull a fast one on the network, and they're trying to double spend. You don't know which of the 4, well, actually, no, you still don't know which of the 4 is doing the double spend, but you know that somebody's double spending, and that's an invalid transaction. So in order for a transaction to be valid, you need to have that ring signature, which authorizes one of the inputs, but it kind of hides behind these decoys, so you don't know which one. And then the key image allows you to make sure that nobody's duplicating their input and trying to spend it twice.
One of the criticisms I've heard of Monero, is that Monero creates privacy through obfuscation and sufficiently complex systems, whereas Zcash creates privacy through math and encryption. Is that a Is that a false characterization?
There's a kernel of truth to it. So, privacy is largely about the anonymity set. So basically the anonymity set is this concept in privacy where if I see an action, if I observe an action on the network, anonymity set is the set of people or actors, I guess they don't have to be people, the set of actors that could have taken that action. So in Monero, when I see a transaction on the network, the set of actors is the people that are the inputs that, well, I don't actually know who they are, but the set of actors are the people who had the inputs that are associated with that transaction. So I don't know which one it is, but there's only 4 of them. So my anonymity set is 4, and it's a pseudo. There's the pseudo-anonymous, so it's a little bit more challenging. But the anonymity set is much smaller theoretically than something like Zcash, where the system works in this kind of like global mixer level. So I can put my Zcash in a shielded address, and that kind of puts it in this global coin pool. And then I can generate proofs that I'm spending out of this global coin pool, and I have the authority to do so. So theoretically, my anonymity set is quite large. It's the entirety of the people who've contributed to that Zcash private pool. It's not everybody who uses Zcash. People who use the transparent addresses are not part of the anonymity set, and that's one of my complaints with Zcash is that there's so many transparent transactions happening that are doing nothing to add to my privacy. In fact, they're detracting from my privacy. But in Monero, you do have a smaller anonymity set. It's really the size of your ring. But that said, in a practical manner, you can get very good privacy by using large mix-ins and maybe using a couple levels of mixing. That's not to say that a very motivated, very powerful state adversary couldn't de-anonymize you by putting a lot of effort into figuring out what's happening on the Monero chain. And it's quite likely that they are trying to do that. It's somewhat fair, but I think that, obscurity, you can get quite confident that you've removed enough of your fingerprints on a transaction through a couple of layers of mixing that the privacy is still quite good.
The cost of figuring out what was happening by a state actor would be so enormous that in most cases it would be prohibitive. If you needed to send a transaction and your life depended upon that transaction not being discovered by a state actor, which protocol would you use? Would you use Zcash or Monero?
I would probably use Monero myself. I think that using Zcash privately is still a bit of a challenge, just because you're still revealing so you'd have to use Monero, but you'd also have to use a number of other techniques, and I guess you could do the same with Zcash, but you'd want to use anonymous VPN, relayer. You'd want to probably want to have a couple of layers of routing away from your IP address. You don't want to have any sort of attachment of your IP address to this transaction at all. So you would want to, go through a couple of, I think they call them bastion servers. So you basically set up a number of servers and you SSH in through all of them. And then you, at that point, connect to a VPN, and then you relay your transaction, and you kind of hope and pray that your OPSEC was really good.
We're having a lot of discussion about Monero and Zcash here, so we might as well delve into Zcash. Could you walk us through your thoughts on Zcash, ZK snarks, and the strengths and weaknesses of that protocol?
Sure. So Zcash it's an actual implementation of I think it was the Zero Cash protocol. This is ZK snarks are theoretically sound ways of generating the best privacy known possible, because it's a global mix-in pool. So you put your coins in this pool, and then you're able to make these assertions about your coins without revealing which ones are yours. This is called a zero knowledge proof. So you're able to prove something happened without revealing anything about that thing other than it's true. ZK snarks, I'm not going to try to explain them. I don't understand them myself. I think there's probably only 5 people in the world who truly understand them. This is really heady, like math, that you need a PhD in cryptography to really wrap your head completely around. But the general idea is that you can prove your transaction is valid without revealing when you sent those inputs. The weakness is with ZK snarks, and I know they're acting to remedy them. I actually recently participated in a new ceremony. So there's a great Radiolab podcast, I believe it was Radiolab, that talked about Zcash and the ceremony. And this is a podcast where they talked about the actual generation of the Zcash parameters. So this was a really delicate moment in Zcash where they actually had what's known as the trusted setup. So they had, I think, 8 people come together to create these parameters. And if they were to collude, they could actually print Zcash out of thin air. So we're trusting that they didn't collude. And that's something that a lot of people have had a challenge with. So they've actually decided to redo that trusted setup with a lot more people. And so myself, I actually participated along with one of my colleagues. And I think they've gotten a number of, I think they're planning to get at least 100 people to participate. And as long as one of us is honest, you can actually trust that no Zcash is going to be, minted out of thin air. So this trusted setup was, a bit of a challenge for some people. They're remedying that. So that's really exciting to see. The founder's reward is something that's also generated a bit of controversy for Zcash. Monero is much more of a Bitcoin-like cypherpunk endeavor. Anonymous developers just throw it out there, let miners get the coins, and that's how we're gonna do the minting. Whereas Zcash, they actually decided that they wanted to set up a Zcash company and a Zcash foundation, and they would get a fairly sizable slice of the network reward. I think they're going to get 10% overall of the supply, which is fairly modest compared to a lot of the newer ICOs, but still offensive enough to some purists that they decided to fork Zcash. So there's now Zcash Classic. I think that Zencash is a fork of that. So there's which added back in the mining reward, which is really, or the founder's reward, which is really nonsensical, but it's there. So Zcash, it's got a lot of really exciting backers. Even JP Morgan is looking at using some of their technology on their own internal blockchains. So Zcash has generated a lot of buzz. My only concern with it is that the cryptography is really complex and really new. I think that when it's so complex and so new that you really want to be patient with, trusting lots of funds to it. It's really very much an experiment. I think a lot of these networks are. And sometimes I think people get a little ahead of themselves, thinking that this is a bit more mature than it is. These are very experimental networks, and we're still just figuring this out. And Zcash is one of the most experimental out there. So there's a lot of exciting reasons to be bullish about Zcash. They have a great team, a lot of amazing cryptographers and developers, and they've got a lot of exchange relationships. And theoretically, it's the best privacy you can get. It's still a little expensive to generate a private transaction. I think at one point it took a couple of minutes to generate a shielded transaction.
One question that I often find myself pondering is why the relative difference in market cap. Like, if I were just looking at this as an outsider, I'd say Zcash has a partnership with JP Morgan. They're traded on Gemini. They have hardware wallet support on Trezor and Ledger. There's a Zcash investment trust. All signs point to the fact that Zcash might be worth more. Like if I was just purely looking at those signals, I'd say Zcash is worth more. But then Monero consistently is in I believe the top 15 and often in the top 10 in terms of market cap. How do you think about that relative difference, and what do you think is priced into that delta?
I think a lot of that is just a function of where they are on their inflation schedule. So Zcash is a much newer protocol. Its supply schedule is very similar to Bitcoin's in that they want to be 21 million Zcash. So there's a lot of Zcash still to be mined. Whereas Monero, as soon as they hit 18 million, they're gonna be on their tail emission. So they're much more mature along their emission schedule. So there's just a lot more of the Monero supply already out there. A lot of this can be just explained by just how far they are along in the emission schedule.
I hear that argument. I guess my I think a lot about market caps, and it seems like sort of the scarcity of the token would be priced into the value of the token. So if Zcash tokens are more scarce, people ought to be willing to pay more for them. Otherwise these projects should be able to just like say their outstanding supply is a gajillion and inflate their market cap. But I hear you.
Well, I mean, just keep in mind how many Zcash are being created every day. There's a lot of Zcash hitting the market every day relative to how much Zcash is out there. The supply is more like a fire hose out there right now. So, when you take the fully diluted supply out, I get that I hear that you're not totally convinced, but I think that is a large piece of what's happening here.
Fair enough. Why do you think there's been such institutional support for Zcash versus Monero, again, with the Zcash investment trust and adoption on Gemini, the JP Morgan relationship? There just seems to be a lot of momentum. Is that primarily because of a technological difference? Is that marketing? How do you think about that difference?
From my perspective, that's largely due to the structure of Zcash. I mean, so again, Zcash has Zcash Company and Zcash Foundation, and they have known figureheads and marketing departments, and they're run very much like a institution. It's a technology, it's a network, it's a protocol, but the surrounding organizations are full of humans that actually can respond to a JP Morgan inquiry. There's really nobody you can send that inquiry to with Monero. I mean, you could send it to Fluffy, but he'll probably laugh at you, say, this is this is a cypherpunk kind of enclave. We're not going to talk to you, JP Morgan. So I think that it's cultural and it's structural. I think that really Zcash has formed itself to be much more friendly to kind of existing institutions, whereas Monero is much more like, hey, this is the future, and we don't really care about the legacy institutions. It's an informal structure in Monero. It's anonymous developers, kind of on a GitHub, on IRC. There's nearly no formal structures to Monero, versus Zcash has much more formal bodies that can be interfaced with and talked to in terms of business development.
Is there another player in town, or is it really, Zcash and Monero? Like, when you think of other tokens, I guess in my mind, like, I've definitely heard of Verge. I've heard lots of criticisms of it. And then I think about like Ethereum playing around with ZK snarks, and then Bitcoin talking about the potential for confidential transactions. What else exists out there, or do you think is pretty close on the horizon?
Bitcoin and Ethereum both have significant privacy improvements that they're working on. I think that those are the biggest threats to Monero and Zcash is Bitcoin and Ethereum. I think it's going to be an uphill battle, though. I mean, backwards compatibility on a network like Bitcoin or Ethereum is tough, and it limits you quite a bit. You don't want to break compatibility with all the systems that have been built already. So adding significant privacy improvements technologically and culturally is going to be a big challenge for Bitcoin and Ethereum. That said, those networks are so large that even if you can get a small subset of those networks to adopt your techniques for privacy, the anonymity set may be sufficient that it actually does rival a native privacy-focused network. So I think that Bitcoin and Ethereum are the biggest threats, but I don't see anything else. I mean, there's Dash, which outside of its initial scam launch is actually not bad. It's kind of got a native coin join built into it that's run by masternodes. That said, there's almost certainly people collecting data on the masternode network and compromising privacy in that way. Dash had what's known as an Instamine, which a lot of people see this as a scam. I don't necessarily see it as a scam. What happened was 6 million Dash were created in the first 24 hours. And then the people involved with Dash were like, oh, whoops, I guess we'll just keep all that Dash. So, whether that was intentional or not is up for debate. But a lot of people see that as an unfair launch. And that's kind of a black mark on Dash's record.
What are your thoughts on the anonymity features of the Lightning Network? Have you looked at that?
Yeah, I think that is something that's promising for very small payments. The thing about the Lightning Network is that you need to find a route between you and the recipient, and that route has to be wide enough in terms of the channel size that you can make your payments. There's some ability to find, lots of routes for really small amounts, like pennies, and you may find that you're able to like blast a number of pennies in a number of different routes and get them to the recipient and do that in a fairly secure and anonymous manner. So I'm not an expert on Lightning Network, but I do know that the routes are somewhat hard to decipher, and it's really not clear where they begin and where they end. So you can get some privacy through the Lightning Network, but the Lightning Network is such early days, and it's so small, and really the routing and the topology of the network is still really rough. I would probably not use it for privacy anytime soon, but I think there's some theoretical advantages to it that hopefully will be realized.
Would it be correct to say that, like, to your knowledge, all forms of token-based privacy is some kind of glorified mixing with perhaps more obfuscated and larger anonymity sets, but nevertheless, it's about mixing?
I mean, I would say that's fair. I mean, I think at the end of the day, all of these networks have a limited supply of coins, and the network's job is to keep track of them in a decentralized way where everybody can kind of check each other. And in order to make transactions happen, the coins are going to have to come from somewhere in that network. And the goal of privacy is to make it so that it's not obvious whose coins are moving to whom. So it is, I think, fair to say that they're all at some level a form of mixing. You want to basically move money without being identified as a single individual. You want to kind of get lost in the crowd.
Let's move to chapter 5, which is about decentralized exchanges. What are your thoughts on decentralized exchanges? Has Scalar Capital placed bets on decentralized and non-custodial exchanges like 0x or AirSwap?
Indeed, we're really excited by decentralized exchange. The idea that exchange can happen without needing to trust a third party with my assets is very exciting. I think we've seen a number of problems with centralized exchanges. There's been a lot of hacks. There's been some exit scams. There's been some freezing of funds. So the idea that you can have an exchange where you can get the assets you want, sell the assets you want without needing to hand them over for any extended period of time is very compelling. So we have been placing bets in decentralized exchange vertical. Full disclosure, 0x founder is actually Linda's husband, my co-founder's husband. So we have close ties to the 0x team, and we're very bullish on everything they're up to.
One of my favorite things about decentralized exchanges is that you don't have to do account creation. There's no KYC, AML, etc. Do you believe that, 10 years out, 15 years out, that is going to be more likely than not that almost all transaction in commerce in the space will not require an account?
I like you, I'm very pleased when I can do something without generating an account. For one, I hate passwords. For two, I hate giving up my identity when I don't need to. But that said, I think that accounts are here to stay. I think a lot of people do find some comfort in knowing they have an account with a trusted institution. I think that the Coinbases, the Geminis, Poloniex of the world, I don't think they're going to go away, but I do think that in many markets and in many situations, we'll find people opting for decentralized exchanges where there's no accounts and there's no custody. And I think that it's nice to have a mix of both options available to you. So I think that we'll live in a hybrid world where some people can go completely accountless. Some people can have some accounts for some purposes and do other things without accounts. And then some people will just want to stay in the sandbox of knowing they have a login, a password, and a phone number to call if something's going wrong.
Okay, let's kick off chapter 6 now. I'd like to know, as an investor in the space, what are your thoughts on institutional involvement in crypto assets and crypto asset investing? I know custody has been an issue, and that wall of institutional money that everyone is anticipating coming in, like, it isn't here yet, but it does seem like infrastructure is being built. What's your view on our progress institutionalizing this space and this ecosystem?
From an arm's distance, it definitely looks like paint drying. It's like we're watching paint dry, waiting for the institutional investors coming in. But when you actually dig into it and you start having conversations with some of the people at these institutions, they're very sophisticated, and they're actually looking at this with a very keen eye. They're talking to a number of fund managers. They're talking to a number of custody solutions. They're doing their own homework. I just think that these kinds of endowments and pensions, they're not going to come in a deep way, but them dipping their toes is often $50 million, $100 million checks. So I think we'll start to see more and more of them come in through vehicles like the Andreessen Horowitz crypto fund. So that's Chris Dixon and Catherine Hahn have launched that $300 million fund. I think that that's really going to kind of turn the tides a bit and get more and more institutions excited and eager to invest. a lot of the institutions that I've talked to, they're taking it even more seriously now, even despite the downturn. So the downturn doesn't deter them. A lot of institutions, they have a very long-term horizon. They do their homework and they take a long time, but they're very long-term minded. And I think that once we get some of their capital in the doors, that's going to really change the game. So taking a step back, I'm really excited by the integration of these crypto networks with the traditional financial markets. So we saw tip of the sphere with the CME and the CBOE launching the Bitcoin futures markets. Those markets have slowly but surely been adding more and more brokerages that offer them more and more liquidity. I think that that's really important. And at some point, we're going to have kind of this nice curve of expectations where, the futures markets can duke out what is the Bitcoin price going to be in 2 or 3 months. And people can kind of express a view on that through the futures markets, and more in hedge funds and more traders can all express views, and we'll get a more sophisticated market viewpoint and more liquidity. And then that futures markets, they should feed into the spot markets and really just start to generate a more of a mature asset class. So a mature asset class needs robust futures, it needs robust derivatives, it needs lots of liquidity, and I think that we're getting there. It's definitely feels slow. When you take a step back, we've made a lot of progress. Goldman Sachs has a crypto trading desk. A lot of these institutions are taking a very close look at it. We've talked to a number. I know other fund managers have talked to a number of them. So I think that it's not going to be like a wall that all of a sudden, 10x is the crypto market and institutions are here. It's not going to be that binary. It's more of a kind of a gradual shift into the market. And I think you're already seeing a little bit of it. It's going to just kind of slowly but surely come in over the next months to years. And then it'll be here and you'll be like, wow, it'll feel like it was always there. It's not going to be like, oh my God, what is happening? Institutions are here.
With LedgerX, we have a clearinghouse that's pretty good. We have OTC desks. We've got CBOE, CME Group with, derivatives markets, futures. We've got an ETF potentially on the horizon. We have in other countries, we have ETNs. What other financial products do you think we most need and are you most excited about that would help boost the space?
Well, we need Vanguard and we need Fidelity. We need those ETFs. Eventually the SEC is going to run out of excuses for why they can't approve a Bitcoin ETF. I mean, the SEC's, this is just my view and not legal opinion, but the SEC, in my opinion, the SEC's job is to protect investors from being defrauded. The job is not to protect them from investing in silly, stupid things. So as long as the risks are being disclosed, as long as the markets are, behaving as they should without, overwhelming manipulation, which is going to be harder and harder to do. Manipulation works when you have a $10 billion market cap, a $50 billion market cap, maybe $100 billion, $200 billion, $1 trillion market cap. It starts to become quite implausible to actually have broad manipulation. Like there's just too much money in there to have to corner that market and manipulate it. So I think the market size is going to give the SEC some comfort. But, this ProShares ETF application, it's based exclusively on regulated derivatives. It's based on the CME and CBOE derivatives. And it doesn't actually, in my opinion, look very different than like an oil ETF might that's based on futures. So the instruments that the ETF provider wants to trade in and invest in are completely regulated and completely within the sandboxes of institutional friendly regulated environment. And the ETF itself is never touching Bitcoin. It's only getting exposure through these regulated markets. I'm optimistic that it'll happen. Maybe not this year. It might take another year or two. The SEC definitely likes to take their time, and nobody wants to be the one to stick their neck on the line to approve something that could cause retail investors to lose money. And they definitely could. But as long as the risks are disclosed and people know what they're getting into, I think the SEC is eventually going to have to allow it just because that just seems right.
The ETFs open up the ability for large index funds and, the vanguards of the world to get in a pretty easy way. That's really exciting. And I agree that it's going to happen. We might have to wait for a few generations of career SECers to buy enough Bitcoin.
Yeah, there you go. I think it'll be in the next coming years. I've thought too many years in a row that it's going to happen this year, so I'm not saying that anymore. But I think that eventually it will happen. I'm pretty sure.
What are you hearing? As someone who trades somewhat actively in the space, what are you hearing from OTC desks? Like, I know on various aggregator websites and exchanges, you can see exchange volume, by different market pairs. But what's happening in the OTC desks is pretty opaque. I know you're not an OTC desk operator, but I'm sure you speak to them quite frequently. What do you see from your vantage point is happening on the OTC desks?
To be honest, it's quite opaque to me as well. We do have relationships with a couple of OTC desks, and I do speak to them occasionally, maybe on a monthly basis. I know that volume is robust. I know that a lot of the volume that happens definitely happens on those OTC desks. If someone's going to buy $5 million worth of Bitcoin, that's a really big challenge to do on the exchanges, and you're going to move the price quite a bit. So a lot of those kinds of transactions happen on the OTC desks, but yeah, unfortunately, I don't really have too much insight as to how that's changing on a monthly basis.
No problem. Switching gears to talking about the current bear market that we're in. What are you hearing from other crypto hedge funds? Is it harder to recruit LPs right now, or is it easier because there's the perception that we should buy the dip and institutions kind of operate on their own timelines, which are kind of not so much affected by the knee-jerk reactions of bull and bear markets? What are other funds experiencing with their fundraising cycles?
I think that different LPs have different kinds of psychologies. I think you're absolutely right that institutions operate to the beat of their own drum, and they've a lot of them have said, hey, it's going to be Q3, Q4 this year. It's going to be Q1 next year. And that's how they think. They think like 3, 4, 5 quarters down the road. That's when they're going to be deploying. So I think that they are largely undeterred. And in fact, I think a lot of them really appreciate the dip in prices. They're able to get in at more modest valuations, which is, good for upside. But, a lot of the high net worth individual LPs, I think, are a little bit more reluctant to get in as we're going through the bear market. I think as soon as we find a more stable bottom, the appetite will come back.
For Chapter 7, can you share with us what your favorite resources in the blockchain and crypto asset space are, starting out with perhaps your favorite events?
I'm really partial to the academic technological events. They're not so good for maybe business development, but they are better for learning about the space. So Scaling Bitcoin is a really, really good one. The Berkeley has I think it's called CESC. I forget what it stands for. That's a really great event. So I really like anything that Stanford and Berkeley put on, and obviously those are local to me, so that's easy to get to. I know MIT has a number of events. I've heard great things. I think there's an MIT Bitcoin Expo. I haven't actually attended it myself, but I look forward to attending a future one. Consensus in New York, that is just a mania. That's mayhem. But that was also a lot of fun. I don't know that I learned a ton, but I definitely met a bunch of people and appreciate being in that environment just to see the Midtown Manhattan vibe. Midtown Manhattan and blockchain, that mix is just, it's explosive. That's certainly a fun one to go to.
What you're saying seems to confirm what I've heard from another number of other people who I respect, and that is that proximity to makers tends to create better conferences rather than proximity to investors or people on the biz dev side. So I often hear people, refer to, DevCon or Denver or Scaling Bitcoin or like the Zcash event I've heard really good things about. What about favorite blogs and, Twitter feeds? Who do you follow?
I love Chris Dixon. Chris Dixon has a lot of great work out there. Crypto Twitter is just full of lots of opinionated people. As far as recommending specific people on crypto Twitter, oh geez, I have to recommend my partner Linda. She puts a lot of great tweets out there. I think Fluffy Pony is a fun one to follow. Not all of his tweets are quality, but many of them are, and they're always funny. I really like to just go to Reddit. I know Reddit's kind of a wasteland, but if you just spend 10 minutes on Reddit, you can kind of get enough of a sense of what's happening in the industry, and you can get links to the latest news. Don't spend too much time on Reddit. I don't want you just get sucked into it because you can. But just touching base with Reddit helps you keep tabs with the current events. I like to read Hacker News, and I think Schneier on security is another really good one. It's not cryptocurrency focused, but I really like the way he thinks about kind of computer security, operational security, and he touches on a lot of current events too.
One of the things that I love about the crypto space is that it seems to be bringing people away from their Bloomberg terminals and more into like Telegram and Reddit. So it's kind of creating this consumerization of investor knowledge. You've got people on Twitter like Crypto Yoda who have, like, in my opinion, some really compelling thought pieces, but it's an anonymous person whose avatar is Yoda. There's a lot of good knowledge out there. It's often not in the same sources though that you would go to if you were in like equities markets or something. What about favorite like newsletters or books? Any other resources that are top of mind that you might refer listeners to?
Well, Nathaniel Popper's Digital Gold, I can't recommend that one enough. It's not technical, it's more cultural and historical, but it talks a lot about some of the early pioneers in this industry and gives you a bit of a flavor of what the early days in Bitcoin were like. So I really love that book. I actually gave it away to my groomsmen as a groomsman gift. So it's definitely near and dear to my heart. And then Mastering Bitcoin, if you're a bit more technically inclined, I think it's a great book for just understanding the protocol at the underpinnings, really the deep layer.
In Chapter 8, we're going to close our conversation with a lightning round of overrated, underrated. I'm going to name a concept, a technology, maybe a company, a product, a jurisdiction. Then you can respond with if you think this thing is underrated or overrated by the market. You can also say pass, or you can say that it's adequately rated, which is a boring but often truthful answer. So we'll start off with index funds. Are they overrated or underrated?
Overrated.
Okay, crypto index funds are overrated. Any additional color there?
If you look at the top 10, there's enough garbage in there that I would not want to own an index of the top 10.
For sure. Monero, underrated or overrated?
Underrated.
Underrated, yeah. Zcash, overrated or underrated?
Adequately rated.
Adequately rated, okay. Verge, overrated or underrated?
Overrated.
Okay. ZK Snarks, overrated or underrated?
Adequately rated. They're getting a lot of hype right now. I think that's largely deserved. But again, I don't think they're going to solve the world. I think it's just another building block that we have to take into account.
Schnorr signatures, underrated or overrated?
Oh, underrated. I don't hear enough about Schnorr signatures outside of the core dev circles. These are really game changing. This is actually going to be providing users economic incentive to get better privacy. That's going to give them better privacy, give others better privacy, and it's going to make things cheaper and faster to validate. Definitely underrated.
Could you give us just like the 1 to 2 minute high level overview of what they do?
So sure. So Schnorr signature is the idea that, well, it's a different type of signature. It's a cryptographic building block that allows you to have one signal signature validate a number of different inputs. So the Schnorr signatures are often talked about in the context of Schnorr signature aggregation, which means I'm going to take X inputs and I'm going to take the signatures and I'm going to combine them all together into a single signature. So you can have one signature that represents authorization over a number of inputs. And when you combine this Schnorr signature with CoinJoin, you basically break a lot of assumptions about transactional graphing. So you can break the assumption that all the inputs are controlled by the same person, because people are going to be incentivized to actually combine their inputs together into a single transaction with a single signature. And this is going to make it faster to validate, cheaper for the users with better privacy, and it's going to just really help the privacy of Bitcoin.
At a high level, the benefits are cheaper transactions, more privacy. Does it also help with scalability? Indeed.
So there's going to be a single signature for many inputs, which consumes less data, consumes less, it takes less time to transmit over the network, takes less space on the hard drive. And with the block size limit as it is, it means we can fit more transactions into a block.
Does it require a hard fork of Bitcoin to implement, or can it be implemented with the soft fork?
I don't believe it does require a hard fork. I don't know the latest and greatest, but I think that SegWit opens the door for Schnorr signatures, and I think that it can all be done with soft fork.
Okay. Ecosystem funds, overrated or underrated?
Overrated.
Overrated. Okay.
I don't think that you need to focus exclusively on any one ecosystem. A fund should be a bit more greenfield and unconstrained, in my opinion.
Crypto asset investment theses, overrated or underrated?
Adequately rated.
Okay.
I don't know.
Okay.
I think it's important to have a thought on what you're doing.
Yeah, sure. Bitcoin Cash, overrated or underrated?
Underrated.
I saw one of your Medium articles on Bitcoin Cash. Are you still pretty optimistic about the promise of Bitcoin Cash?
I am. There's been a lot of tools built for Bitcoin that have since left Bitcoin because Bitcoin doesn't want to scale. I think that, it definitely brings a different set of trade-offs and a different topology. It's not one where you can verify the transactions yourself on a Raspberry Pi. But if you decide that maybe businesses are in a better place to verify transactions and you can do more simple payment verification, SPV kind of verification for yourself, the style of light client that many people use on Bitcoin and are quite comfortable with, you can have a system that just provides a lot more utility to a lot more people. So I think that there's promise with Bitcoin Cash, and I think it's generally underrated.
Bitcoin, overrated or underrated?
Underrated. Bitcoin is still dismissed by many people in the mainstream and in the world, and I think that's a mistake. I think Bitcoin is kind of proven itself over the last 9 years, and it's being used more and more, and definitely is here to stay. So,
EOS, overrated or underrated?
Oh gosh, overrated.
Dfinity, overrated or underrated?
Adequately rated. There's a lot of hype for Dfinity. I'm optimistic that they've got some clever, novel schemes. They're taking quite a bit of time to actually launch. I don't think a threshold signature scheme is going to necessarily win the world over just in its own merit. I think there's a lot of hard work in terms of building the network effects that it's going to need if it wants to compete with Ethereum.
Tezos, currently overrated or underrated?
Currently underrated. I think a lot of people have really thrown Tezos to the side. Kind of, they had a lot of political problems, a little political drama, and then currently, I'm actually quite upset with them over the KYC AML news. But at the end of the day, I'm still optimistic that they've got something really exciting that they're building.
Stellar, overrated or underrated?
Overrated.
Ripple, overrated or underrated?
Even more overrated.
Ethereum.
Underrated. I think a lot of people inside the crypto community are really excited about Ethereum, but Ethereum has, at the application layer, way more teams working on building it out than any other network, including Bitcoin.
Casper and sharding and other scalability solutions for Ethereum, are those overrated or underrated?
Those are adequately rated. I mean, they are a step on the journey to scaling. It's not going to solve everything day one. It's getting a lot of hype, but also the people are getting a little impatient as well. I'd say it's fairly rated at this point.
Binance, overrated or underrated?
Overrated.
Oh, interesting. Why is that?
Well, they are definitely positioning themselves to get themselves in some regulatory hot water. I think the Binance coin, is kind of dicey in terms of actual value that it brings. The sources of demand are very transient and short-lived. They give you discounts on fees, and they buy back with some small share of their profits for some period of time. But those are not permanent sources of demand. So as far as the Binance coin, I don't like it as a long-term investment, and Binance itself, I think, is, it's showing what you can do if you're going to just ignore all regulation. But I don't know if that's going to be a sustainable strategy.
Maybe playing a little bit fast and loose with the laws, and could find themselves in hot water. Potentially, yeah. Coinbase, overrated or underrated, or pass?
I'll pass on this one.
Okay.
Thank you for reminding me of that option.
Decred and other governance coins, overrated or underrated?
Underrated. I think the Decred team is great. I think that they've done a lot of awesome work, and I really like having an on-chain governance. I know that some people aren't as much of a fan, but I think that, democracy is, it's the best form of government it's better than all the other forms. I forget the exact quote, but, it's
the lesser evil.
Yeah, Yeah, it's a lesser evil. So I think that it's a valid experiment and an exciting project.
The role of location in hedge fund success.
I think it's overrated. I think that you can really do this from just about anywhere. It definitely helps with access to information, but I think that we're getting into a world where location is not as relevant.
Well, that wraps up this conversation with Jordan Clifford from Scalar Capital. I hope you've enjoyed it. See you next week. Take care. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.